personal finance segment, and for that Faye is ready. So Faye, what are we learning today, or what is up for discussion?
Well, obviously there's that extra 50,000 rupees within the ATC, within the ATC allocation right now. So what we're going to try and figure out today is how we should allocate that extra 50,000 rupees. Now remember, this is applicable from April 2014. So these are your investments that you can make this year, that you have that extra 50,000 rupees on tax savings. So let's find out what the options are, and let's bring in Dhirendra to tell us which one is most attractive at this point. Dhirendra, thank you so much for joining us. Of course, interest rates are fairly high. So there is the PPF, there is the 5-year fixed deposit that we can opt for, there's the NSC, and there's also equity-linked mutual funds. Which one do you think we should opt for that extra allocation?
I've always felt that, ATC is very crowded. All kind of expenses, all kind of long-term expenses, or, the child's tuition fee, your pension premium, the mandatory PPF, Provident Fund deduction, or, contribution to Provident Fund, whether it be EPFO or Provident Fund deduction. They are all part of ATC. So most investors do not get an opportunity to plan their ATC allocation. Given the situation that there is a hike by, increase of 50,000 rupee, and Indian investors generally do not have any equity exposure, including your mandatory Provident Fund contribution, which is generally fixed income, I would say that use, if you have over 5-year time frame, then always invest, avail ATC with tax saving fund to the maximum. These will be your only equity exposure. They are the only ones which will be most tax efficient and sizable gain potential. That apart, Indian investors equity, and when you invest with such time frame, then you are unlikely to go wrong. If anybody has ever invested in equity regularly with a 5-year time frame, one has generally mostly beaten the fixed income return. I'm not saying you have ended up in positive territory. I'm saying that you have generally beaten the fixed income return. And that is great, because you are able to completely eliminate the possibility, the downside or the risk of equity with your attitude to this. And the 3-year lock-in period also has, made it beneficial for investors to think long-term, because investors are able to withstand their anxiety the moment you realize that you can't take your money out.
All right, Dhirendra. In fact, we have a question for you from Savio Pinto, who's written in. Now, he tells us he wants to begin investing in mutual funds. So far, he's only been using fixed deposits. So he's one of those investors that you were just talking about. The interesting thing is he has 10 lakh rupees right now in a lump sum amount that he'd like to put away. He has a time horizon of 8 to 10 years, which is always a good thing to hear. So for Savio right now, Dhirendra, what would you like him to do? Would you like him to maybe do a systematic transfer plan and move money from one fund to another?
Savio, you just have the kind of time frame why you should consider a mutual fund with an equity component. My suggestion to you will be as followed. Think of 1 or 2 balanced fund. For your kind of investor, we run this stable growth portfolio. Take 2 funds from this stable growth portfolio. You have to make sure that you are not investing your 8 to 10 lakh rupee at one go. You must spread your investment over the next 18 months. As you are investing for nearly 10 years, spreading your investments over the next 10 years, over the next 18 months, will ensure that you are not catching a market peak. It will also save you from all the anxiety which the market's ups and downs will cause. So these 2 things, if you follow, I think you will be experiencing a very unusual experience from equity. These funds invest not more than 70% into equity, so they are relatively more stable. They provide you a relatively more stable experience, and for this kind of time frame, I'm sure that you are likely to end up with at least 20-30% more return than what you'll get from your fixed income investments.
All right, taking baby steps there into equity using a balanced fund would be the best way to do that. Let's take another question. Pavan Agarwal has written in, Dhirendra. Now, he tells us he invested about 3.8 lakh rupees in mutual funds. It's now at 4.9 lakh rupees, so he's made a profit. He wants to know, should he book his profits or should he stay invested? That's a question a lot of our viewers have at this point, Dhirendra. What would you recommend he does?
My suggestion to Pawan Agrawal will be that don't try to time the market, don't look at the investment values. Be guided by your own goals. If you are unlikely to need your money for next 5-10 years, I would suggest that keep adding some more savings into this fund, into these investments. Maybe add 5,000 rupees a month, maybe add 10,000, whatever you can add. And if you are saving for a goal, then before you need the money, estimate that 18 months before that or 1 year before that, you will start methodically exiting your investment before you need the money. So that you don't wait for one day to redeem your investments. Just because the investment has gone up in value, you should not be prompted to redeem your investments, because most of the big moves in the market happens when you least expect it. It happens with a surprise. That is what we have seen all the time in all these years. So there's a great possibility that the day you redeem, one might get the finest phase of the market over the next period, over the next 6 months, 1 year, I don't know. So be guided by your goals, be guided by your own time frame. Otherwise, if this is a long-term investment, you are unlikely to need it any time. Maybe redeem a small part of your money periodically just to have fun. Otherwise, let your money accumulate.